Hello and welcome. I'm Natalie. Let's talk about money. So today we're diving into a real world example of buying a home. We're going to buy a $250,000 home with 20% down, a fixed interest rate of 7.42%. So if you're wondering whether paying off your mortgage early is actually worth it, stick around because the numbers may actually surprise you. And it's kind of fun to play with when you go onto one of these calculators. So let's just break it down a bit. So I'm using Bankrate to get these numbers, and you can, do the same just by Googling Bankrate mortgage calculator in Google. That's how I found their calculator. Dave Ramsey, of course, has a mortgage calculator. Most banking institutions have a mortgage calculator, so you can find this easily. I just happen to be using Bankrate. And you're buying a $250,000 home in this example. You're going to be able to put 20% down, which is $50,000 up front, which is a lot of money that a lot of people aren't able to do. But that's what you should do, is a minimum of 20% down. And that means that you're actually going to finance $200,000 with a 30-year fixed rate mortgage of, again, it's going to be 7.42%. The 7.42, I looked on Google and I said, what's the average mortgage interest rate for the average credit score of 700 to 759? I believe the average credit score was like 717 the last time I checked. So that would be your average rate, is about 7.42% right now, which is really high compared to the 3% we had a couple years back. So those are our numbers that we're working with. Now, at that rate, your monthly principal and interest payment is about $1,386 per month. That's your mortgage and interest. That's all it is. Now, typically when you buy a home or when you mortgage a home, you do have to also include in that mortgage payment your annual property taxes or your monthly property taxes, which in this example, I just pulled a number of $4,800. That's about what I pay, so I figured maybe that's average. I don't know. $4,800, which is about $400 per month. And then also your home insurance, which is, I again just pulled a number out, in $1,300 a year, which seems a little low to me now that I think about it, but whatever, $1,300 per year, which is about $108 per month for your insurance. So with all of that, that means principal and interest is $1,386. You have your property taxes for $400. You have your insurance for about $108 per month. So your total monthly payment would be approximately $1,894. Now let's talk about the long term here. So over the 30-year life of your loan, you'll pay a total of around $311,000 just in interest. That's just interest. So that means that the interest you've paid over the course of a 30-year loan, that's just if you make your standard payment every month, just regular payment of, what did we just say? $1,386 is the actual mortgage payment. Just do that every month. You're going to pay over $300,000 in interest. And so the total cost of your loan, if you add the $200 that you actually received plus the interest, your loan value, or your total cost of your loan, not value, your total cost of your loan is $511,000. You didn't know you were buying a $500,000 home, did you? No, you didn't. But you are when you do minimum payments. So basically you bought a $250,000 house, and over time you're actually paying more than double that in interest. So that's craziness. That alone is a big enough reason for me to stop and to increase my payments so that I don't have to pay double what I originally loaned. But here's where things get exciting. So what if you were able to pay an extra $300 per month towards your mortgage, towards your principal on your mortgage? So if you were to do that, $300 per month, you'd cut out about 8 years of your loan. 8 years. So you'd have an estimate of paying it off in about 22 years. And you'd save nearly $93,000 in interest. $93,000. Imagine if someone were to write you a check for $93,000 and said, "Thank you, I appreciate you paying me off early." That's incredible. So that's a serious return. because you've cut off almost $100,000. You've cut off 8 years of payments, and all that from just paying a little bit more per month, which $300 is not a little bit. But some people will seem as if that's easy. Some people can do $500, some people can do $1,000, some people can do $3,000. It's crazy because that part does depend on your income and your available to spend. If you're $100,000 in debt because you have credit cards and cars and student loans and all these other things, making extra payments may be nearly impossible. So get out of debt. Get out of debt before you buy the home, though. And just, even just beyond the math, because of course, the numbers are what I like. I like to look at the numbers and know how much am I going to save? How much am I going to have extra? How much this, how much that? That's what I like. But it's more than just the numbers. So think about a time in which you can have no more monthly mortgage payments or rent payments for that matter. That would decrease your financial stress a whole lot because you don't have thousands of dollars moving off into la la land to buy this home. You would have more flexibility in now and in your retirement because if you had an extra $1,300 a month, that could perhaps go to a retirement account instead. Now, regardless of whether you have a mortgage or not, you still do need to pay property taxes and you still do need to have home insurance because if your house burns down like mine did, you don't want to replace it with no money coming from the house that burned down. All right? And think about it as the more flexibility you have in retirement, the faster your path is to get to wealth. And that's really what we're after, is to get to wealth where you can be comfortable. Not that you're going to be running around rich all the time, but so that you can be wealthy enough to not have to be worried about a stack of bills that you have to pay. So just think about it in your mind. Imagine being completely mortgage free. If you have kids before your kids graduate or before you hit retirement, imagine what that is like. That's peace of mind that you can't put a price on. I promise you, if 30 years ago, I would have thought I could be mortgage free. Man, I would have worked a whole lot harder 30 years ago. Man, because the freedom it provides, it's incredible. Again, imagine having an extra $1,386 per month to do whatever you want with. For me, it's putting money aside to pay cash for the car. For you, it may be putting money aside to send your kid to college. For you, it may be setting money aside because you want to go travel the world or whatever. It's total freedom. It's total peace. And of course, you do, while you are paying off a mortgage, you do always want to make sure that you are setting yourself up for retirement. So always have a retirement fund there where it can be building. Get out of debt as quickly as possible. You should be out of debt before you even buy a home. But if you did buy a home already and you're in debt, get out of debt. Get rid of those stupid credit cards. Get rid of that stupid car payment. Get out of debt. Get rid of all that nonsense. And if you build yourself so that your financial base is solid, paying off your mortgage early could be a complete game changer. Because again, you can do the stuff that you actually want to do. So, I don't know, is it worth it to pay off your home early? I mean, to me, with numbers like these, with saving almost $100,000, to me, the answer is an absolute yes. Absolutely, without question. Because financial freedom is within reach. It can be within reach. You just have to be dedicated and want to do it. And you also should invest in yourself today so that you can make a difference for others tomorrow. I appreciate you stopping by today. Go ahead and give the video a big thumbs up. Leave a comment down below. Be sure to subscribe. When you subscribe, you should hit the bell so you know when the next video comes out. I thank you so much, y'all. Y'all have a great one.